Hello all, welcome to Finterpret. This is Prasanna. I teach finance at ISB. With me I have Nishant. He's a senior PhD student at ISB. Please look at our episode 1. We have discussed what this series is about. Whole idea in short is to simplify academic papers and explain how they are useful in real life, whether it's for policy, whether it's for personal investment, whether it's for understanding what is going on. So these papers have tremendous practical value and explaining these things in simple terms. That's the whole purpose of this series. So thank you for your feedback. We asked feedback from you and many of you have written to us, and we have tried to implement many of the suggestions that you made. In fact, one of my students suggested that we appear very, we appeared nervous and held our hands together and all that. So we have practiced to keep ourselves open and appear brave today. So even those minutest of the feedbacks we have taken into account. So without wasting much time, let's get into the topic. So Nishant, we were discussing this paper on banking on deposits maturity transformation by great scholars published in the Journal of Finance. And about this puzzle, if you can go on. The idea is this: look, in the US, that banks mostly lend long-term loans. What do you mean by long-term loans? There, even fixed interest. That means once you decide on an interest rate, that does not change whenever a central bank changes interest rate. They lend long-term loans, but their liabilities, which is deposits, they are floating, in the sense whenever interest rate goes up, you have to change interest rates on their liabilities. In that case, when interest rate goes up, so their interest expense, which is the on what they have to pay on deposits, will go up. Interest income does not go up because that is fixed. So they should be in trouble, and this is what the practical popular narrative is. Whenever there is an interest rate increase, you find analysts telling us sell bank stocks, it's going to go down. And you showed us last time that that's not going to happen.
Yes.
Banks are not the most affected, and you showed us this graph, and quickly I'll tell for the viewers that red line that you see is the interest income of the bank, net interest income of the bank, profitability of the bank, and that fluctuating line is the interest rate charged by Federal Reserve on the left side if you see the figure. So the Federal Reserve interest rate has moved dramatically, but bank's profit seems to be stable, at least the what we call as net interest margin. And then it seems to apply to India also, that's on the right hand side. So this is a puzzle we were discussing.
Yes.
And you seem to suggest that there is some hidden asset that banks have. And can you explain that with a simple example?
Yes.
I know for IIT IIM type it's very difficult to be simple, but try to be as simple as possible. Otherwise, I am their viewers to simplify.
No.
Yes, let's move on.
No, I'll try to be very simple with this. So this particular balance sheet is itself a very simplistic representation of the actual balance sheet of a bank. Here we have on the asset side, we have long-term assets and short-term assets, and by long-term assets we mean the long-term loans that banks are extending. These are fixed rate loans which do not reset at regular frequency. So you can think about it, loans are
some mortgage, 30-year mortgage,
30-year mortgage loans which are completely fixed rate for the entire period of the 30 years. And then there are short-term assets like investments in short-term bonds or investments in or some kind of floating rate loans which keeps resetting in 3 to 4 months. On the liability side, on the other hand, here we have a savings deposit. Here we are assuming the equity capital to be zero. These are very simple assumptions that we make generally in academia to just express that point, make the point about.
Yeah, we'll come to that. We'll discuss that.
And we will discuss it in more detail later. So now, what should happen with this particular balance sheet? How should 1% increase in central bank's interest rate affect this particular balance sheet of
I think I have a suggestion to viewers. Why don't you pause this for a minute and just think about it, what will happen? Of course, we are going to continue. You pause, right? 1% and let me try. You are IIT IIM and I'm not. I'm BCom. So let me, whether I can understand, let me make an attempt. So this tells me that if Federal Reserve increases interest rate by 1%, so because liabilities you said will be reset quickly, the deposit. So bank's expense should increase by 1 rupee because they have a 100 rupee deposit, but their income will go up only by 75 paise.
Yes.
Why? Because that 25 rupees that they have lent on long term, by contract they can't increase interest rates.
Yes.
So they are going to lose 25 paise.
Yes.
But your figure shows their income does not change when interest rate goes up, right? This is the whole puzzle in another way.
Yes.
So now can you explain why does this happen?
So now banks have this have this power called deposit franchise.
Okay.
So what happens is banks do not So for a 1% change in interest or increase in interest rate, the banks will not change the deposit rate by exactly that 1%.
They are going to change less.
They are going to change it less because of that power that the bank has.
And that's the discovery of this paper.
Yes.
So the central discovery of this paper, like in natural sciences, even in economics, finance, papers discover something. The discovery of this paper is that there is an asset called deposit franchise, which banks have, which is not shown in balance sheet, which gives them this power of not increasing interest rates on deposits when the market interest rate goes up.
Yes.
Right?
Yes.
The increase is not one-to-one.
Yes.
When central bank increases interest rate by 1%, banks increase by less.
Yes.
So let's say, so can you illustrate in this case what can happen?
So let us look at situation 2. Again, this is a very specialized hypothetical example for understanding. So let us say for a 1% increase in interest rate, now the banks are only transmitting 75% of that increase to their to the depositor.
So this electrical engineering thing will never stop, right? So if when banks you're saying, suppose banks have the power that when there is interest rate goes up by 1 rupee, 1%, they'll increase interest rate only by 3/4%.
Yes.
Right?
Yes.
So in that case, what will happen in this balance sheet? Again, let me make an attempt.
Yes.
Right? So because now your 100 rupee deposit, central bank goes up, increases interest rate by 1%, your cost will not increase by 1 rupee now. Because you have this power.
It will only
70%. So what do you mean, viewers, by this power? Power means even if I don't give this depositor what is available out there in the market, because they can go out and get this 1% extra, they will not leave me.
Yes.
This is the power that I have as a banker for some reason. Where it comes from, we will see. So I can get away by not increasing interest rate as much.
Yes.
So in this case, I increase interest rate only by 75 paisa.
Yes.
Not 1 rupee.
Yes.
On the asset side, anyway, I am getting 75
paisa.
So I am hedged.
You are hedged, completely hedged.
So I am not losing any money.
Yes.
So it's not a surprise.
Yes.
So this deposit franchise lets me do this. This is the magic you are showing. So, this figure is showing the same thing.
Yes. This figure is the exact thing that this paper is about.
Right.
This is the contrasting thing that this and any paper in finance and economics, they have this story, one single story to sell, and this is the story that this paper is selling. That under situation 1, which is the conventional, more talked about situation, more and commonly viewed situation, as the interest rate increases, the bank's profitability or the net interest income of the bank should decrease.
Yes.
But we have demonstrated in under situation 2 that it remains flat, and that's what this paper is talking about.
So that means if the banks have even more power, let's say you give a hypothetical example of passing on just 3/4, right?
Yes.
What if they can get away by passing on only half the interest increase? Can you do you have an illustration?
Yes, we do have an illustration.
So it's a prepared one. We are pretending as if on you're coming out with on the fly. That's okay.
Yeah.
People will understand that. Let's move on. Yeah.
So now again very specialized example. Now we are saying that for a 1% increase in interest rate, the deposit rate the interest expense increases by only 50 paisa.
Because bank has even more power.
Yeah,
so this depositor is not going to leave even if I just give that person half of what additional interest rate that has happened. So what it will allow the bank to do?
So now if you want to fully hedge that 50 paisa increase in the deposit or in the interest expense on your liability, you can have you can increase your long term asset from 25 to 50 here, because with a total asset of 100 and of that 50 rupees in long term asset, if the interest rate increases by 1%, your interest income will now also increase by 50 paisa.
This seems a bit complicated. What you mean by hedge is that if you want to be totally insulated from interest rate shocks, now you can have 50 rupees of long term loans instead of 25. Why is that? Because when 1% interest rate goes up by 1%, your interest cost is only going to increase by 50 paisa.
50 paisa.
Like, because on 100 rupee you are not going to increase 1 rupee.
Yes.
So therefore you can commit to invest 50 rupees in long term assets or power projects or whatever lend, because where you don't change interest rate regularly. And 50 you only need to keep 50 in short term. Now what's the advantage to the bank? Why should I can understand advantage to the society, right? You can have investments, jobs if you have long term assets. What will bank gain by this?
So generally what happens is, on a long term asset you can charge a higher interest
okay,
rate
yeah,
compared to a short term
annualized
loan.
interest rate.
Yes,
It's not always true. Sometimes the other way around we
Yes,
can discuss, but
yes.
mostly it's called term premium.
Yes.
So long term interest rates are higher, and
Yes.
banks make money.
Yes.
So the point is banks are naturally hedged.
Yes.
All of this drama around asset liability management, most of it may not be required as much because banks have this deposit franchise, which is an asset, which gives them this power not, to sort of withhold some of the interest rate increases, right?
Yes.
This is what you're trying to say.
Yes, yes.
Now the question is, where do they get this power from? And this is all imagination of some academicians, or people in the real world also talk this language.
Yes.
May not be these words.
Yes. Yes.
Because you made all those crazy assumptions, no capital and all, people are already upset with you. What are you talking
Yes.
about? This may not work in real world, right?
Yeah.
So let's come to the real world. Tell us, where is this coming from, and some real world way, people have, whether they recognize this.
So just like any other company, even banks to build this power, they have to make some fixed cost. They have to spend something.
Right.
So for example, they also spend, just like any product company, they also spend in marketing to extend their reach to the customers, to give more convenience to the customers, so that the depositors come to them.
Right.
And even if they are changing the not changing the rates on the deposit in proportion to the change in the interest rate, the depositors stay with them because of that convenience or that reach that the bank has given or provided to those depositors.
Sure.
So it is through those
So
investments.
this is this marketing and all kinds of expenditure that they do that gives them this
Yes,
power,
yes.
branch and
Yes,
all
yes.
of that
Yes.
that do. So so that means these are not expenditures. So in accounting, we consider all of this as expense.
Yes.
So you are saying this is an investment bank does.
Yes.
And that creates this asset.
Yes.
And because of which there, banks that spend a lot of on building branches, make these nice branches.
Yes.
I remember when I grew up, private banks started coming. They had AC.
Yes.
Sometimes we used to go to ATMs just for AC sake.
Yes.
And then they recognized and they draw us away from the ATMs.
Yes, yes,
That's what we used to do. But these are not just. This is giving them a power that the depositor will not leave you even if you don't pass on the full benefit.
Right.
That is
Right.
this asset this paper is
Yes.
talking.
Right.
Do the people in the real world recognize this in India?
Yes, in fact, we have an excerpt from the IDFC conference call, which is the closest you can get to the real world, right?
Yeah.
It
It
is
is the
a-
real
it
world.
is-
What do you mean by
it is the
closest?
real world. Yeah. It is.
Yeah.
So as you can see this from this statement. So let me just say that one defining factor for the last 5 years has been deposit growth period, and all of us know that deposits practically are the foundation of any bank, and this kind of deposit growth has come despite the fact that along the way we dropped interest rates. Most people thought that we stay with a 6%, 7% strategy for a long time, but literally within 3 years we dropped it, and now we pay 0 to rupees 1 lakh. We just paid just 3%, and still last quarter we saw a deposit growth by 43% by year on year.
So it's not.
So
look at this. Initially when they were not known, this is IDFC. Maybe the CEO speaking. I don't know.
Yes.
Whoever is speaking
Yes.
in the conference
Yes.
call.
Yes.
Initially, IDFC Bank was not well known. This deposit franchise asset was not there.
Yes.
So that time they had to pay something like 7%.
Yes.
Now he's saying it's like fixed 3%.
Yes.
And RBI has increased, as you know, in the last 3 years. Repo rate has gone from 4% to 6.5%. Despite that, they are getting away with 3%
Exactly.
savings rate,
Yeah.
and that means this is happening in the real
Yes.
world.
Yes.
So it is not some fiction of imagination of some academician sitting in the US,
Yes.
right? So this is giving an explanation why this is happening,
Right.
So
Right.
now, so the balance sheet therefore should appear something like this, right? In reality, you should recognize this asset.
Yes.
So we will discuss more about this in the coming episode. So all that we established today, that banks acquire this power of not passing on all the increased costs, and that gives them a natural shock absorber against interest rates hike.
Yes.
Now what happens when interest rates go down? This is another thing that we have to discuss. Whether these things apply to India. Does a person who is not in the academia, like our producer Aditya, can they do something from this? Is there a trading strategy coming out of this?
Yes. Yes.
Maybe banks will think about it, and we'll discuss more. And we are not responsible for your losses. If you make money, please tell us. But then think about it: banks having more deposit franchise versus banks with less deposit franchise. When interest rate goes up, their stock prices should react differently. At least what this findings of this paper.
Yes.
Some of you can at least see it on paper. So where are some practical implications, and can it lead to more research on countries like India? People at CAFRAL, which is RBI's research wing, and we'll discuss their findings in the next episode. They are doing something, and we are also doing something. Right? So we'll discuss all of these aspects: applicability to India, the real life implications in terms of trading, regulations. Some of the regulations, are they in contrast to these ideas, in the next episode, and we'll end with the final summary. So we plan to finish this in three parts.
Yes.
Thank you so much, Nishant.
Thank you.